Next, I'm happy to introduce our second customer keynote presenter. Marty Young is the CEO and co-founder of Buckle, the inclusive digital financial services platform serving the rising middle class and gig economy, in addition to insurtech and fintech strategies. He's a globally recognized Wall Street professional with over 20 years of special situations experience. Marty is a West Point graduate with a master's in operations research from Georgia Tech and an MBA from the NYU Stern School of Business. After serving as an infantry officer in the US Army, he has continued to serve our nation as a National Guard Army officer and chaplain. Please join me in welcoming Marty Young.
Thank you. Thank you for having me here today and letting me share Buckle's story, as well as our vision for the insurance industry. Buckle is the inclusive digital specialty financial services platform serving the rising middle class and gig economy. And by specialty financial services, we mean both insurance and credit. We've built one of the best executive teams in the insurance industry, and within the category of full stack insurtechs, probably the best. To have a little bit of fun, between Christy Mattis, Sharon Fernandez, Jim Cramerino, Bill Breslin, my guess is most of you here know at least one of the people on our executive team, because they're tremendous depth and breadth of experience in the insurance industry. I'm often asked, how did Buckle, this insurtech company, acquire such talent to basically move the Buckle vision forward? And the answer I give is usually in two parts. The first part is our vision. Our vision is we want to help people achieve economic freedom. The idea of economic freedom is very much in line with the nature of the gig economy, which is that somebody should be able to work when they want, for how much they want, doing what they want, for whom they want. Really empowering workers to basically opt in and out of income-producing opportunities. And that's a very lofty vision. But we think it's the future of the middle class here in the United States. The problem with this is that the banking insurance infrastructure today works very well in scale if you have 2 or more years of W-2 history and a credit score of better than 670. As many people know who fit this category, if they want to go buy a home or a second home or get an auto loan, they're paying low single digits in interest rate, and they're also paying very competitive rates for their insurance, whether title insurance or home insurance or automotive insurance. However, if this is not you, and you fall into the category of what we call the working non-prime and are a member of the gig economy, you pay on average 50 to 100% more for your auto insurance and 1,000% or more in interest and fees on your auto loans and leases and other financial sources. The problem the gig economy is exasperated because the vast majority of gig workers do not get W-2 income as their sole source of income. In fact, over 50 million Americans reported some sort of Schedule C income in their tax returns in 2019. This is the growing middle class, we believe, the rising middle class. And so you can imagine when a gig worker walks into a bank and says, I need a loan, and says, here's my W-2 from Walmart, but I only work there for benefits. And here's my 1099 from Uber, and here's my printout from DoorDash, I need a loan. The quick response of any banker, or for that matter, any traditional insurance agent is, I don't know what to do for you. Because you're involved in rideshare, you're involved in delivery, you're doing personal stuff. You know, how do you solve for that? And so as a result, they're left behind by what's happening as these services are growing. It's further exacerbated when you think about the automobile tends to be about 40 to 45% of the take-home pay of the average gig worker. And so the automobile, which is often needed in order to basically grow your income and achieve higher levels of strata within socioeconomics, becomes what we call a credit score trap. So poor credit history means a low credit score, which means higher rates of insurance and higher rates of financing, which means now less net income to pay debts and miss debt payments, and on the cycle goes. And this affects most of the people that actually do work in this country, meaning physical work. About a third of America has a 670 or lower credit score. And then there's a very large portion of people that have either no credit score because they're unscorable, or because they have no credit score because they're what's called credit invisible. And who are these folks? Well, they're the folks that often are working as bartenders, baristas. They have jobs at Walmart. They work in fast food. And the reason you see this phenomena is that in this country, Amazon today is happy to pay you $15 an hour, which is viewed as a competitive wage. However, Amazon doesn't want you to work more than 40 hours a week and take overtime. So now you have to go out and you need to supplement, because 40 hours a week at $15 an hour isn't going to make it work. So you got to supplement. And that's what's basically going on with this growing gig economy and its workforce. So our vision at Buckle is to enable this economic freedom by helping people escape this credit score trap and join the rising middle class through really three strategies. One, obviously saving money on insurance, because of their credit score, they pay 50 to 100% more than somebody with a good credit score. Helping people save money on their credit, which is by far the bigger problem, the bigger pain point within these working classes. And the third is through our partnerships to make sure that our drivers have more earning opportunities. So for example, with our partner Lyft, Buckle drivers make more than non-Buckle drivers. So by helping people earn more and save money on insurance and save money on credit, we can move the needle by 5 to 30% in somebody's annual take-home pay. Now, this is a very hard problem. So as I think all of you are consumers of gig services, most of you took an Uber or Lyft to get here. Many of you do DoorDash, many of you do Instacart. What you probably have realized is rideshare risk is different than food delivery risk, which is different than package delivery risk, which is different than shopping risk, like in Instacart, which is different than our partner GoPuff's risk, delivering all sorts of things at all hours of the night. This is a very, very hard problem when you look at it, both from an insurance as well as a credit perspective. Now, I'm not an insurance executive like all of you in this room or those of you streaming in, but I come from the world of credit. And I'd like to offer a credit perspective on the future of insurance that really answers now the second part of how did you attract the executive team you did? And the answer is, I think the future of insurance looks a lot like credit evolved over the last 20 years. So a little bit about me. So I've done over $30 billion of restructurings across over 75 transactions. I've worked for every institution on Wall Street of materiality. Over 90 credit institutions, not all of them exist. But both as a financial advisor and as a chief executive officer put into situations to get debts repaid or restructured. And so I can't help but look at the world through the eyes of a credit person. In fact, when I watched Game of Thrones, what I took away was the most powerful and enduring institution in the Game of Thrones was the Iron Bank. And it didn't surprise me that a faceless man in Arya Stark, the debt collector of the Iron Bank, ended the Night King, which then enabled the Iron Bank to collect a very large, tidy installment payment later on in the show. And yet the Iron Bank will endure all those houses in Westeros. In fact, credit's been around longer than any other record we have in human history. We have credit records that are older than the Bible. And as Alexander Hamilton understood, in order to make the United States viable, he had to build a modern financial banking system that was heavily reliant on credit. And that's why your dollar bills say, for all debts, public and private. The credit markets, to some degree, rule the world. And when credit markets and governments cooperate, money is created. So now, looking from my eyes as a credit person towards the insurance industry, first I observe that insurance is a negative-sum game. And I get into debates over some of my fellow insurtech founders about this, but what I tell them is for every dollar you pay an insurance company, you get back less on average. It's principal loss ratio. And if you did a really good job in creating a new insurance product that saves people money, great. But what just happened is the whole market just got smaller and the rest of the market got less profitable. That is a negative-sum game. So why do we play this negative-sum game? This squid game, if you will? For the same reason the contestants in the squid game played, because their creditors compel them to. Your lenders require you to have title insurance when you buy a house. Your lenders require you to have insurance on your home. Your lenders require you to have automotive insurance. And the reason we do this is credit, when it's done correctly, is actually a positive-sum game, as every homeowner knows. And what I've observed is that profitable credit risk requires property and casualty insurance as a credit enhancement. Profitable property and casualty business is a credit enhancement, and unprofitable property and casualty business is an equity enhancement. This fundamentally is why we use credit score in scale in personal lines. Credit score enables lenders and insurers to avoid equity risk and equity enhancements and basically take on the more profitable credit risk. Second observation, for any given value chain, equity and credit should be segregated, or what are often referred to as alpha and beta risk, to optimize capital efficiency and structure. I won't nerd out on you on credit math, but I will point this out, which I think might be surprising to a number of people in this room, is that in an efficient insurance market, market forces naturally separate alpha and beta risk, even in a suboptimal structure. The number of reinsurers is equal to the square root of the number of insurers. And this has been proven both mathematically as well as empirically. This is an important equation because this suggests that the insurance industry, insurance math, is actually a special situation of credit math. And in addition to alpha and beta risk, credit markets have engineered for gamma risk, or what we call uncorrelated risk, such as COVID, cat events, war, and financial crises. And we've gotten really good at it. In fact, when COVID hit, I think immediately everyone thought this could be another depression. But all the plumbing and architecture was already built. We just plugged in government balance sheets and everything just kind of worked pretty much just fine. The insurance industry has a way to go in dealing with its gamma risk problems, which I'll address in a minute. Finally, again, my perspectives on this, the insurance industry is insurance that is required by law and regulation, commoditizes insurance into cost of living, cost of goods sold, and or redistributes wealth, but reinforces 1 through 4 above. So my perspective is, as a credit person, not an insurance person, on the credit industry. Now, let me give you, the insurance industry, some perspectives on credit. First of all, we look at industries as being in perpetual need of low-cost capital and credit. But these industries come and go. In fact, one of my clients understands that every company it lends to will eventually liquidate. And we know this to be a fact. But why does that happen? Generally, it happens because of 1 of 4, and every now and then maybe 2 of 4 disruptive forces. These disruptive forces cause companies to restructure, as well as redistribute wealth and assets on the disruptors. So when I worked on the restructuring of Silicon Graphics, it was because Apple Computer built a supercomputer for $2,000 that went on your desktop that obviated the need for workstations. That's what happened. And although Silicon Graphics was a very proud company that, Toy Story 1 and Jurassic Park was all done on their platforms, Apple obviated that through technology. When I worked on the restructuring of Blockbuster, both Blockbuster and Netflix were distributing DVDs by mail. What Netflix realized is something had changed in consumption. People wanted to binge watch. They didn't want 1 or 2 DVDs in the mail. They didn't want to go to a Blockbuster and make it a Blockbuster night. They wanted 4 to 6 DVDs in the mail, and they wanted to binge watch. And that insight into the change of consumption bankrupted Blockbuster. I've worked on the restructurings of most of the rental car companies over the years, and I would simply say that the bankruptcy of Hertz last year was because Uber and Lyft were allowed onto the airports, which was a regulatory change. When the airports let them on, 75% of the business of Avis and Hertz came from airport rentals. And as many of you travelers know, getting a rideshare was a lot cheaper, faster, better, less headache. You get some time back than basically going down to the rental car center and getting a car. And then finally, you see ESG issues. So worked on the restructuring of Remington. Unfortunately, after Sandy Hook, nobody really wanted to finance gun companies anymore. But at the same time, Elon Musk was able to get hundreds of millions of dollars of almost zero-cost debt in order to basically fund Tesla for 5 or 6 years. So the reason that industries restructure and are disrupted tends to be these 4 forces. The most disruptive thing I've seen in my lifetime is the gig economy. And it started off with rideshare and blowing up the taxi and limo industry, where you saw that prior to rideshare, taxi limo was a $23 billion market. Rideshare grew the market of this idea of ride as a service, but it blew up the medallion markets in its wake. It then went on to basically blow up the rental car industry. In 2015, when I was restructuring one of the largest rental car companies in the country, I saw it. There was $100 billion of debt and equity propping up the top 3 platforms, Avis, Hertz, and Enterprise. That's no longer the right number as a result of rideshare. As basically the gig economy grew, we saw that it was growing in the world of non-standard auto. And last year during COVID, I would tell most non-standard auto carriers and MGAs, 3 to 5% of your loss ratio is probably this thing called the gig economy. Nobody believed me last year. Now I tell them it's 5 to 7% of your loss ratio. Now nobody disagrees with me. So the gig economy is growing out of this world of non-standard auto, and it's creating all sorts of problems in that universe. Restaurants, Uber Eats, DoorDash. We saw it happening in 2019 when people were starting to have food delivered more than they would go to dining rooms at restaurants. COVID accelerated. Restaurants are starting to look way different than they did 5 years ago. We have restaurants now that are called ghost kitchens, right? And we're in the early days of basically the transformation of this idea of food in this country. Retail caught everybody by surprise because prior to COVID, most major retailers were really afraid of Amazon and saw what they were doing. But because this gig workforce emerged out of nowhere, major companies like Publix or H-E-B or Best Buy or Walmart can deliver things faster, better, and potentially even cheaper than Amazon, which means the whole retail model is about to go through a new series of evolutions because of the gig economy. Then you have commercial real estate. It's not just work from home, it's also get anything you need delivered at home, whether food, a ride, or a service. And commercial real estate, we're in early days, but you're gonna see a lot of restructuring in commercial real estate assets around the country. You haven't seen it yet because of the microchip shortage, but I bet you in all your companies, there are conversations going on that go like this. Honey, we have 2 cars, you work from home, I only go in 2 days a week. Why don't we have 1 car? And that's starting to catch on as a thing, as everybody's sort of realizing that maybe that 17 million cars we used to consume a year, and by the way, we'd buy those 17 million cars, and 23 and a half hours a day, they would just sit somewhere doing nothing. That's going to trigger a whole series of restructuring events in the automotive industry the next probably 2 to 5 years. And then finally, as basically these dynamics are changing, the way we think about both credit and insuring these vehicles has got to change. Now, what I would tell you is the credit markets already know this, and they're not afraid. And the reason they're not afraid, even though they have trillions of dollars of debt invested into these companies, into these industries, is because we figured out how to basically break apart the value chain and to basically handle industry restructuring and disruption at scale. So in the mid-2000s, I was doing a lot of work with JP Morgan, Kmart, Hostess Brands, Blockbuster, and saw that he had figured it out first, which was that JP Morgan was going to get out of the, quote, the risk-taking business into the risk-moving business. And when that happened, it enabled platforms like Blackstone, Ares, BlackRock, Vanguard, and others explode because they realized that a bank at that time was this weird amalgamation of equity risk, credit risk, market risk, regulatory risk, and operational risk. When the financial crisis hit those banks went away. But if you could basically break apart the value chain and you could push the credit risk into the asset managers, keep the equity risk at the borrowers, use investment bankers to manage the market risk, use banks to manage regulatory risk, and servicers to manage the operational risk, you could take serious punches, and it's okay. Because the system was designed to basically create these interesting portfolio effects and move on. So our realization at Buckle is that insurance companies today, like banks were 15 to 20 years ago, are a weird amalgamation of all these risks sitting in a single legal entity. And so our paradigm was, let's break this up. Let's put the alpha risk into MGAs and insureds. Let's use reinsurance brokers to deal with the market risk. Let's run our carriers as fronts and keep them focused on regulatory risk. Let's build a digital TPA powered by Guidewire that would deal with the operational risk. And then let's partner with the reinsurers, which are really the analogy of the capital markets. So we broke apart the value chain. So what does Buckle look like? So Buckle is this very interesting platform that is able to create very bespoke solutions from the point of risk to the capital markets, using both legal entities we own as well as third parties we can partner with that can plug in. And so Buckle today, in terms of our observable key results, or OKRs, we have omni-channel distribution. You can buy our gig products in the Lyft app. We also have a digital agency. Interestingly, we also have over 1,000 agents and growing, 400 brokers and growing plugged into our system. We have MGAs. We have 3 MGAs we own, and we tell our partners, if it's a gig economy, we intend to own the whole value chain, A to Z. But if it's a consumer risk or it's a commercial risk, we have no intention of doing that. We would like to partner with you, particularly if you think us bringing our gig economy products can help you solve some of your segmentation issues within your book. So we have third-party MGAs focused on non-standard auto, as well as certain commercial risks like taxi or limo. In fact, if you took a taxi here, there's a 20% chance we insured it. We have carriers. We have owned more carriers than any other insurtech, but we run them as fronting companies. Over 100 licenses, 1,500 plus authorities. We have a captive digital first TPA, best-in-class systems powered by Guidewire, and we are really optimizing for non-standard auto and the gig economy. And then in terms of reinsurers, we have a very capital-efficient model where we transfer a lot of the risk, not all the risk, because we'll never ask a reinsurer to take more risk than we do, to be clear. That, we believe, aligns incentives very nicely as we think about all the different risks, not just in terms of underwriting risk, but operational risk, market risk, regulatory risk. So we want the incentives nicely aligned. We have over 3 panels, 9 plus reinsurers, more coming. And then certain MGA partners that want to participate in the risk, we have a sell captive carrier that they can do that. And so this platform has really never been seen before in this industry. But I would tell you as a credit executive, this looks to me like credit more than it does insurance. The risks are nicely compartmentalized in the right statutory entities. In fact, the insurance industry inadvertently has done this. There are 5 regulatory regimes. There are agents, there are MGAs and GAs, depending on your state. There are carriers, there are licensed TPAs, there are licensed reinsurers. So the regulation has already been created to break it apart. It's just, unfortunately, most insurers are this strange amalgamation of everything kind of bundled together. So testing our theory, and as we put it into practice, I'll share our economics as of September 30th, where we closed the quarter. So we're earning $100,000 a day in gross earned premium. We're a statutory filer, so you'll see all this in a couple weeks. $25,000 a day in net earned premium, because we're never going to ask a reinsurer to take on more risk than we do. we were earning $20,000 a day in fees for providing paper, claims, technology, data, and other services we offer, and controlling the value chain from the point of risk to the point to the capital markets, and then a blended loss ratio of 65%. The insight is that the gig economy is highly fragmented. This is a game of massive segmentation, and we had to build a platform that could go and do that well in scale. And so if you look at what is Buckle, Buckle is this insurance as a service platform where we're partnering with regulators, we're partnering with TNCs like Uber and Lyft, as well as delivery network companies like Favor and DoorDash. We have agents, we have MGAs that are traditional, plugging in, that are taking advantage of our cloud-based everything in the cloud platform, that they can basically choose which services they want to include as they basically tie that risk to the capital markets. We have fantastic data partners in many of the names that you know here today, service providers, even carriers. You're going to see us partnering with more carriers. It's public that Assurant, who's the largest player in providing gig economy insurance, is both a partner and investor in Buckle now. We have technology partners, not just in terms of insurance, but really everything. Everything is changing, even things like Zoom and Slack. We are a work-at-home first company, and we probably always will be, because we're going all in on the future of work. We have fantastic insurtech partners, such as Guidewire here today, and we thank you for hosting us. But it's really exciting for us to bring these kinds of capabilities to smaller MGAs that could never afford this kind of technology investment in order to bring value to their insureds, but we can do it by providing this platform. And then we have a bunch of reinsurers, as well as even auto dealers coming into the platform. And auto dealers are going to be very tied to our credit business, but I won't bore you with credit. Although we do believe that although the insurance business will be our bigger business in terms of numbers of customers, the credit business will actually be the bigger business in terms of assets under management. And so that's what Buckle is this very interesting insurance as a service platform designed for hyper-segmentation in line with what's happening with the gig economy. So I'm often asked, like, so where is this going? And certainly going back to sort of that equation I showed you earlier, I look at the insurance industry, and some of you know we've already purchased some assets because we were running a mergers and acquisition strategy from insolvent carriers, and we're in the process of doing that. And I believe in industry cycles. And this industry has got some big issues it's got to work through in terms of things like cat risk, the increasing cost of automobiles, what are manufacturers going to do with getting in the insurance industry, and I could give you a whole slew of things that I know all of you are thinking about today. But I think about the future of insurance that in order for it to work and for it to take shocks to the system, it's got to look a lot like modern credit. And certain risk classes might even converge with credit. But the gig economy is the accelerant. And if you look at the same math I showed you earlier, but now instead of looking at it as insurance carriers that are holding on to that alpha and beta risk and other things, if you were now to look at, let's have MGAs and specific programs, very niche-y, focused on trying to outperform an underwriting profit, i.e. getting alpha returns, and let's have reinsurers focused on the right amount of reinsurance with relatively low volatility, then you find out that this equation might describe the future of the insurance industry, which is that the number of reinsurers is equal to the square root of the number of the sum of the number of the MGAs and programs in an efficient market. And certainly within the game we play, which is the gig economy, non-standard auto, subprime lending, we're seeing this not just mathematically true, but we're starting to see it shape as empirically true as well. But I think the implications to many other risk classes could be very relevant as you sort of think about alpha risk, beta risk, and then gamma risk, because these cat events aren't getting better. So in short, that's how we attracted, I think, one of the best executive teams in the insurance industry. It's not just that we're a mission-driven company, that we have a very aspirational vision of supporting what we believe is the rising middle class. Because let's face it, if the people that work in the gig economy aren't the middle class, this country may not have a middle class, which means I don't know if this country can work. So we need a middle class. And if it isn't the gig workers that are choosing when they want to work or not, then I think that's an existential issue for this country. So Buckle must succeed in its mission and vision. But then in terms of how we're doing this, I think any of our executives say this is fully unique, and certainly it makes a lot of sense as we think about the problems we're solving as well as the future of the insurance industry. So thank you very much for your time today, and I look forward to continuing these conversations as a credit professional, not an insurance professional, but thank you.